Good morning and welcome to the Prescient Investment Management multi-asset webinar for Q1 2023. My name is Natalie and joining me today I have Rupert and Bastian. The first quarter of 2023 saw a continuation of the challenging global macroeconomic environment, signaling potentially tough times for economies, businesses and consumers in the year ahead. Today we will reflect on some key events that have shaped the past quarter and discuss our expectations going forward. Firstly, we've seen a lot of news in the last few weeks regarding heightened risk amongst central banks. So we saw it start with a run on Silicon Valley Bank in the US and then seemingly spread across the Atlantic to Credit Suisse in Switzerland. So Basti, is this something that investors should be concerned about? Is this a similar situation to the 2008 global financial crisis, which was also characterized by bank defaults?
Yeah, Natalie, similar for sure, but also quite different, to be honest. So, it has been an interesting few weeks for us. I mean, we saw once again a bank run. Once again, we saw credit spreads spiking. We saw the Fed stepping in. So no reason to be complacent here. Surely this is highly concerning. But after looking at some facts and looking at the data and looking at one level deeper at the evidence, we are quite sure that this is actually contained, and it shouldn't remind us too much about 2008, and we don't think this is a 2008 all over.
Okay, but what makes you so sure that the Fed has everything under control? What are the indicators that they are actually handling it well?
Yeah, you mentioning the Fed is exactly the right thing. So Fed this time was quick to act and step in fast. I think a lot of learnings had been taken from the great financial crisis, which a key thing here is to just react quick and take away the panic. And why are we so sure that this is contained? Well, we look at the data. So what you can do is you can look at credit default swaps. So these are the prices which are paid for the individual banks to secure your loan, also to basically protect against default, and from that we can infer a probability of default. And if we look at those bank spreads, we can see that it is actually a quite idiosyncratic event linked to Credit Suisse and not necessarily to the entire banking sector. And we can also show that since the Fed stepped in, credit default swap spreads have come down already. I'm just going to look into some of the investment themes which we've been featuring this year. Not going to go into detail, but now focused on the global bank risk crisis. So basically the Credit Suisse takeover and the run on Silicon Valley Bank. And just want to show 2 or 3 charts exactly speaking about these credit default swaps, which I just mentioned. So what we can see in this year here is basically the 5-year bank CDS for various banks. And what it shows on the y-axis is just in basis points the cost to insure against the default of a loan to this bank. And what you can see is that during the crisis here in 2008, that all the banks would basically move in lockstep. The cost of insurance would skyrocket. You can see banks like Citigroup being particularly expensive to be insured against default, and then it abates again after the Fed steps in. We have a little bit of an elevated period here. After the great financial crisis, and then also the aftermath of the European sovereign debt crisis. After that, bank spreads remained tight for a while until we see the spike here during COVID, and then thereafter again now the crisis around Credit Suisse and Silicon Valley Bank. But as you can see, is if we look at the thick lines or where the lines come together, they don't really spike that much. It's really this Credit Suisse line at the top here, this yellow one, which spikes. But we can see that after the spike, basically it comes down quite quickly as well. So now we can say that spreads have been contained, the crises have been contained, and the odds of more bank defaults surely are elevated compared to the past, but we are not looking into a financial crisis 2.0 here.
Thanks, Basti. So could you maybe take us through exactly what the Fed did to contain the situation?
Yeah, it's actually quite simple. So it's absolutely crucial because we must understand that the Fed was really the one institution which just completely avoided any deeper crisis here within a few hours' time. But what they did was pretty simple. So they created a new lending program, which they called Bank Term Funding Program. And within this term funding program, the banks in the States can pledge their investments as long as it's a government bond or a mortgage-backed security or any other government-backed security. They can give it back to the Fed and they can take out a loan at 100. So basically at par value. With that, the whole term risk goes away. And we have seen a lot of term risk for the banks coming through because interest rates went up, and with high interest rates, the prices of the bonds which they held went down. And with that issue to the maturity mismatch which banks generally play, there was a risk that they can't take that loss. What they can do now is they don't have to market these bonds. They can hold them to maturity, and in the meantime, what you can do is you basically can borrow from the Fed. So it's a short-term liquidity solution, but it really helped to eliminate the risk. So what we can see on this chart is one part of the Fed's balance sheet, and this is basically called loans. So what is classified as loans here is the emergency facilities which the Fed provides during certain crises. And you can see they've done this before during the great financial crisis. It was then completely run off, so basically not being utilized by the banks at all. The loan program got basically utilized during COVID-19 or after COVID-19, but ran off entirely again. And now this new set of loans, which basically amounts to $342 billion, so almost call it $1/3 trillion, so quite sizable. That's basically the term funding which is taken up by banks, mostly regional banks in the States.
So looking at your chart, it does seem like the Fed is easing again. So would you say this is possibly the end of quantitative tightening in the US?
Yes and no. So as I said, the balance sheet has grown by $350 billion, which is $1/3 trillion. So that is actually half of what we have achieved in terms of running down the balance sheet through QT. Half of that has been reverted again within just 2 weeks. So yes, the balance sheet has been growing again, but it's not necessarily the end of QT, because to judge that, we really need to look at the composition of the balance sheet of the Federal Reserve, and the composition of the balance sheet of the Federal Reserve has actually changed markedly. It's not the end of QT directly. If I look at the overall balance sheet, you can see that this once again is the loans, so the bank term funding program. But what I will add now is basically mortgage-backed securities and nominal government bonds and notes, which is basically the red and the blue items. And these large red and blue items, which you can see on this chart, those are the bigger items which the Fed is holding on its balance sheet. And you can see that the runoff, so basically the reduction in these assets which they hold on their balance sheet, that has continued. So loans is basically that small blip on top. I don't want to really call it a blip because it's, again, a lot of money. But compared to the overall balance sheet, which is still running off, it is actually not that sizable. And we must also be clear that the bank term funding program is limited to a 1-year period. So we should expect these loans to disappear once again over the next 12 months.
Thanks, Basti. There is so much uncertainty at the moment in the market. We have heightened risk perceived by investors around the news on global banks, and on top of that we have this continued uncertainty from ESCOM, US elections, China, Ukraine. Can you comment on that, Rupert?
Yeah, I mean, not to add Mr. Trump getting his court appearance early this month. So yeah, I think that's exactly it. We've had a risk appetite, or a perceived risk, certainly within global media, that's been quite high for a very long time. I think one of the things that we like to do here at Prescient is to focus more on the actual priced risk, right? So we can read the news and we can see how there's always this doomsday scenario priced in, or at least talked about, but is it actually priced in? So I'm going to focus a bit more on something a little bit more abstract, not the run-of-the-mill investments, but what we do a lot at Prescient is we look at volatility services. So in the options market, you've got implied volatility. Implied volatility is essentially the price that investors are willing to pay for taking out insurance. So think of it this way. So you've got a car, you want to insure your car. How much do you pay for insuring that car, given that you've got a perceived level of risk? Or perhaps you've got a medical aid. How much do you pay for your medical aid? The sum of your payments for medical aid, on average, aren't going to equal the average weighted claims that you're going to take from a medical aid. But you're willing to pay that premium in order to have that certainty of life. So if we look at that in the financial market space, we could look into the options market. So let me take you through some of the surfaces that we look into. So let's look into 3 different markets and how they price volatility. The first being the South African equity market, the second being the US equity market, and the third being the Rand. So first off, what we can see here is a chart which shows us the level, which is this blue line, and the skew on option pricing. Simply put, the level is the perceived level of risk without directionality. So you can see times like COVID, the market loses its head. It's not sure whether it's going to go up or down, so the level of volatility spikes. The skew is the direction that the market is taking a bias towards. So the skew implies that you're either willing to pay more to insure your portfolio against loss, or you're willing to pay more to get upside within that portfolio. So looking at more recent times in the South African equity market, you can see that the implied level of volatility is pretty much near its long-term average. In fact, it's within the 50th percentile. So nothing really to write home about here. In other words, markets aren't in the period of high distress that the news and media might make you think. The second thing that we look at Prescient is the skew. So what is the skew looking like in South African equities? Well, what we see is a skew, if we look at percentile rankings, which is roughly around the middle as well. So nothing out of the ordinary in South Africa, certainly around the South African equity market. Switch that across the Atlantic, if we go to the S&P. So this is where we're talking about the United States and whether there is significant downside risk. Again, what we see is a long-term level of implied volatility, which is roughly around the long-term median. But what we're seeing when it comes to the skew is that the skew has elevated slightly. So nothing too drastic, but the skew certainly has picked up a bit since the beginning of this whole perceived banking crisis. The last one, which I think is actually the most interesting one, is the Rand. So if we go into the Rand, you can see again quite a similar story. The level of volatility pricing roughly in line with both the historic realized levels of volatility, so the actual risk realized by the Rand, as well as the long-term median of implied volatility. The interesting part around the Rand, though, is that your skew is pricing at extremely low levels. So what does that mean for us? It means that investors are generally looking for Rand strength in terms of positioning within their portfolios. And that's quite an interesting one when you tie that back into the long-term narrative around South Africa. Is South Africa a very negative case at the moment? Certainly from the Rand perspective, the view of the market is not so much the case.
So does this mean we can expect a strong bull market going forward this year, particularly amongst global stocks, which took quite a battering last year?
Yeah, good question. So yeah, what I've discussed there is that risk within global markets is nothing out of the ordinary. There's roughly around the median pricing and implied volatility. That doesn't, however, mean that there isn't a degree of directionality within the market. And when we look at the United States in particular, we've seen a downgrade in the growth hypothesis for American investors. So what we saw for the last 3 or so years was an investment thesis where valuations were quite expensive, but there was a strong growth case. What's happened now is that growth case is running down, not quite negative, as I'll show you now, but it's running down certainly below average trend growth, which is not a great thing for US equities. Okay, so let's look into what we call a nowcast of growth within the United States, and then I'm going to compare that to emerging markets, because that's an emerging, if you pardon the pun, trend that we're seeing within our asset allocations at Prescient. So what we do here is we perform what's called a nowcast of economic activity in different regions. What that means is that we're trying to estimate the GDP growth number in real time. Now we know what happens with the GDP growth number. It gets printed 2 or 3 months in arrears, which means that it's old news by the time that it comes out. So for us, the key to this game is to estimate GDP in real time. How does it work? Well, what we do is we take literally over 100 different variables and we build a model which tests them for significance and distills them into the closest model we can get to estimate GDP in various regions. So it's input variables like consumer confidence, but it's also input variables like railway traffic, port traffic, building plan approvals, new hires, all sorts of data sources that you can get off your Bloomberg terminal or off Thomson Reuters. So what does that look like in practice? Right, so if we look at this chart through time, what we can see here is the Prescient Economic Indicator in red, which is estimation of the current growth of the United States economy. Then we've got real GDP growth as printed, but this time pushed back 2 or 3 months in arrears, as if we knew it at the time. You can see that the blue line is above the red line. That's because what we're estimating here is growth above and below trend, whereas real GDP prints with embedded trend. So embedded trend is around 2 to 3% in the United States, and we're looking for estimates above and below that embedded trend. That means that we can have a nowcast of real GDP, if I zoom all the way in here to this very last dot or yellow square, which is showing us 60 basis points or 0.6% real GDP estimate. Through time, it's quite a reliable indicator. You can see these shaded zones showing periods of recession within the United States. It picks them up quite timeously. And how does that look when you look at a scatter plot? Well, if you plot real GDP on the y-axis and then the Prescient Economic Indicator on the x-axis, you interpolate a line, a linear trend through them, and you can take out today's latest reading. You see that change in real GDP estimated at 60 basis points. So quite an accurate model and something that we base quite a lot of our viewpoints on. So taking that into US equities in particular, US equities for quite some time we've shown a strong negative value case. So the PE ratios are unattractive, price to book ratios are unattractive. The levels that they've been pricing at are near all-time highs. They certainly have come off since the sell-off of last year, but still not an extreme value case within the market. What has changed though is this economic growth outlook. So economic growth within the United States used to be positive, our estimate of economic growth, and that turned at the beginning of this year, which pushed this entire asset class view towards a strong negative. So for our portfolios at the moment, we are slightly underweight on global equities based on this. What I wanted to take you into though is the other side of this coin, which is emerging market equities. For a long time, emerging market equities have taken a lot of strain within markets, especially because of their exposure to China, the US-Sino relationship, which fell apart now 4 years ago, and then, of course, exposure to COVID-19. But what's emerged more recently, and you can see a sharp trend upwards here in our score going positive when we are overweight in asset class, is that the economic picture within emerging market equities has changed. And why do I cover that? Well, just to contrast US GDP growth nowcasts with emerging market GDP growth nowcasts. That's this tile here, the dark blue tile, which implies that we are bullish on this particular indicator. And if I dig deeper into that indicator, you can see that if we look at it in a closer fashion, it's been trending upwards. So trending upwards means that we are seeing improvements in the growth outlook for emerging markets. That in contrast to US equities where it's been trending downwards. So overall, we've seen an emergence of the possibility of an investment case in emerging markets, and we've seen a continuation of a negative investment case for, in particular, the United States.
Okay, so you don't think there's a large risk to the global financial sector? Investors are currently not pricing for a massive sell-off, even though there is a lot of evidence suggesting that the global economy is running below trend growth.
Yeah, it is running below trend growth now. We should expect that. We have done a lot of tightening over the last couple of months, and monetary tightening happens with a lag. The impact on the real economy comes with a lag, so we should have expected that to some degree, and that's what we're feeling now. And did Credit Suisse or Silicon Valley Bank default because the rates are at 5? Probably not. Those were quite idiosyncratic risks which came through. We've shown that it's not a deep banking crisis in itself, but is it tougher for these banks to operate at a massively inverted yield curve with front-end rates at 5 and back-end rates at 3? Surely it is. So either way, we can put it whichever way we want to put it. We are growing below trend growth now quite significantly. We're aiming for a soft landing. And that is because of all the tightening. And it's just also important to highlight that tightening financial conditions just doesn't only happen or exclusively happen through monetary policy. It's also wider credit spreads, more uncertainty amongst banks, which means less bank lending, less deposit intake. All of that is, or wider cross-currency basis, generally less uncertainty amongst corporates, more volatile equities, knock to the wealth effect, to the consumer. All of these feeds into tighter financial conditions, and all of that is something which we are seeing now on top of what we've seen over the last couple of months in terms of below trend growth. So when it comes to the Fed, they're kind of getting to target here.
So tying that back to this persistent theme that we've been experiencing for the last few years around central banks, what does this mean for future rates? Do you think that the Fed has reached the end of their hiking cycle?
Yeah, that's exactly what we think. Well, what we think is likely, and we haven't always been right on that last year, but the reality is that we are at 5% interest rates now. Inflation is coming down quickly. So very soon we know we will be looking at a quite significant positive Fed fund rate. All of these tightening factors which I just mentioned on top of an economy which is already growing significantly below trend growth, that should lead us and leads us and should also lead the market and does lead the market to expect the Fed to eventually be done. But with that, there's once again a new risk emerging, and I just want to show that in one or two charts. Okay, so with that, I'm going to look once again at one of our global macro monitors. We're going to drill in onto central bank or global monetary policy pricing. And yeah, we looked at the balance sheets quite extensively. So I'm going to look at straight to the pricing of front-end interest rates. I'm going to do it in this chart. I'll just switch off one or two of the lines. But what we can show in this chart is basically the red line is where the current effective Fed fund rate sits. It's in a range between 4.75 and 5. And then you can see that blue dots on the x-axis are basically into the future where the Fed fund rate is priced to materialize. So basically where the market is telling us where interest rates will be in the foreseeable future. And you can see that the market is telling us there's not much more hikes to come. We are basically the market is telling us 4.93, 4.905 basically now in March, which is now. And that basically tells us that we are done. So the market doesn't expect rates to go up. The market now expects interest rates to come down all the way back to 3%, below 3% actually, by the end of 2024. And why is that a risk? It is a risk because it is something which we've seen earlier this year, that the market disagrees with the Fed and becomes extremely dovish, i.e. once again explicitly bets on interest rates to come down, or the Fed bailing us out if that recession, which we're all expecting, now comes through. Let's see what the Fed says. So the Fed is telling us, if you look at the Fed dots, the median dots at the back end, yes, long-term rates will come down. Yes, at the end of 2024, we're going to be at 3%. The Fed is in strong agreement. But where the mismatch comes in is that the Fed tells us at the end of this year, they will be still at 5%, while the market is telling us at the end of this year, we will already be below 4%. So the risk is that we see a reset of the blue line. The market eventually accepts that the Fed is not going to cut rates as quickly as priced. And with that, we will see an implicit hiking in interest rates. And that's one of the risks which we highlighted before, which came through. And it's particularly worrying right now because that mismatch between like interest rates 9 months from now being priced to be 1% lower compared to the Fed saying being at the same level as of today, that is a stark mismatch, and that holds a lot of risks for us.
Okay, so let's bring this closer to home. I'd like to chat about the March MPC meeting. So we were expecting a 25 basis point hike. The SARB then surprised us with a double rate hike of 50 basis points. How did the markets react to this? And should we expect to see these hikes continuing?
Yeah, that was indeed a surprise also for us. I guess 25 bips was exactly what not just the market, but also every economist who made a forecast expected. So the 50 basis point did surprise on the upside. Normally not good news for the front end of the curve. So the front end of the curve moved slightly higher. Yet it is good news that the SARB is once again showing a lot of credibility and a lot of commitment to keep inflation in check. And one must say that they put this hike through on the back of a significantly high inflation forecast for South Africa. So the hike happened for the right reason, and that credibility was repriced. We immediately saw a much stronger rand and much stronger bonds at the back end of the curve, which is where we are exposed and positioned with our balanced fund. So we are long duration, so we are benefiting from this, and we are also hedging against rand strengths, so hedging against dollar weakness within our offshore assets, and again there we are benefiting for. So for us, this whole Silicon Valley banking crisis, if I may call it like that, because it's not really a global banking crisis, plus these more short-term hiking surprises from the SARB, they're actually playing in our cards, so something for which we are positioned very, very well.
In general, the markets have not been very forgiving this last quarter. So Rupert, maybe you can just take us through how the Prescient balanced and defensive funds have fared and your expectations for the funds going forward.
Right, so I mean, January we had one of the strongest SA equity January rallies on record. It was up more than 10% in 1 month. I mean, if you had a crystal ball, you probably would have gone to cash after that. But February, March saw a bit of tapering on that strong rally, and it meant there was a bit of a roller coaster round trip back to almost flat in SA equities for the quarter. So for some investors, that was quite a tough journey to take. For us, as you'll know, we've got quite a bit more offshore exposure, offshore in particular in emerging markets, but also to a degree in US and other developed markets have been rallying. And that benefited our funds considerably in the first quarter. So March saw one of the best relative performance track records that we've ever had within our balanced and defensive fund. And ranking, I think the one was number 1 and the other one was in the top 5. So a really great March for us and a really great way to end off the quarter. Where do I see us going from here? Well, we've got more exposure in general to offshore asset classes, but we've got less exposure towards naked dollar-rand exchange rate than peers. So when the rand strengthens, that means that we structurally benefit within our fund. With this double rate hike from the SARB, we see more likelihood that the rand will strengthen. There's been a bit of a catch-up game for the last 2 or so years. The Fed hiked, the SARB caught up, the Fed hiked, the SARB caught up. It now seems, as Bastian showed you in one of the charts, the Fed has finished hiking. Whether the SARB has finished hiking or not is a different story, but the double hike that we saw more recently certainly did benefit the rand a lot. Across other asset classes, within a multi-asset balanced fund and defensive fund, we've got access to a whole range of asset classes. We're also increasing our exposure to infrastructure. We've already got exposure to clean energy. That offers a very, very attractive return profile, CPI plus 7 at the moment, so very, very attractive in a smooth type journey. And then across the other asset classes in general, we've got some bond exposure towards the back end of the curve, yielding above 11% at the moment, very, very attractive. As I mentioned earlier, if yields do come in, then there's a large capital gain within the fund. If yields do nothing at all, then we're earning above 11% within this fund on that portion of the fund. So very, very attractive, I mean, I'm always going to say this, but a very attractive forward view within the balanced fund and the defensive funds, and something that a lot of other investors are looking towards as a rotation into someone that doesn't necessarily pick stocks, but it has the ability to port alpha on top of equity exposure.
And then there's some exciting developments for the balanced fund. I don't know if you'd like to share that as well.
Yeah, I mean, one of the biggest developments that we had in the first quarter was that we made it onto the Allan Gray Open list, which means that it's investable for a whole new opportunity or a whole new group of investors. So hopefully going to see some flows from that. And just a great sort of feather in the cap, a box tick for us to get onto that list amongst some really, really great managers.
Definitely. Well, thank you, Rupert. Thank you, Basti. Thank you, everybody, for joining us today, and we will take some questions now. Good morning. Thank you so much for joining us today, and thank you for sending through your questions. So we're just going to jump straight in. So our first question is, isn't it a bit of a complacent statement to say there's no banking crisis, with Silicon Valley Bank and Credit Suisse defaulting literally a few days after each other especially since bank stocks in the States keep on underperforming? Who would like to take this?
I'll take this one. Thanks, Natalie. It is a complacent statement to say there is no banking crisis, but let's look at the numbers, let's look at the facts. It really doesn't look as severe. So what we said and what we've shown in our webinar is that the situation is that Silicon Valley Bank and Credit Suisse are completely uncorrelated events. And it's not that we have Silicon Valley Bank bringing the crisis over the Atlantic towards Credit Suisse. This is not what's happening. It's completely two different, completely unrelated problems. What makes us certain that the problem is not another 2008? Well, the reality is that what makes us certain is the reaction of the Fed. And we must just be aware that a lot has been done to contain this crisis in a very short period of time. So I remember in 2008 at university, it was widely discussed whether banks should be bailed out, whether there should be any support for the banks. We discussed topics like moral hazard. All of that it's all fair, and from an academic point of view, needs to be discussed. It needs to be discussed again. But the difference is that in 2008, we let all of these banks default. Bear Stearns defaulted, Lehman defaulted. This time the Fed is jumping in and making sure that nobody loses actually money. So it's a massive difference. And I do also want to comment on the statement that bank stocks are underperforming. So for that, one needs to actually look a little bit deeper. So, I mean, without me going into the stock-specific space, which we generally don't do, but just to answer the question, so if you look deeper, you will see that the small caps, the smaller banks are indeed still underperforming. That's probably because of uncertainty, which still prevails, especially in those smaller names. But larger banks like JP Morgan just posted like record results, and the stock is actually rallying. It's up since the crisis started. So long story short, it really looks contained.
Okay, great. Okay, second question. Can you discuss the bond market volatility or MOVE index? I think it's near all-time highs. What are the implications of this?
Okay, I'll take that one. Rupert spoke a lot about volatility, so I'll speak about the bond market volatility at least. Good question. So I want to use the opportunity also to relate to our fixed income webinar on Wednesday, because we are actually unpacking and discussing the MOVE index quite a bit in detail. But it is a good question because, and because of that, obviously, want to answer it now. It is a good question because it is the bond market volatility is very different to the equity market volatility right now. So we see a lot of volatility in the MOVE index, as this question states, not so much volatility in the equity market. Why that? So for that, really unpack what is the MOVE index doing. So the MOVE index has nothing to do with credit. It has nothing to do with Silicon Valley Bank or Credit Suisse defaulting. The MOVE index is measuring basically the volatility or the implied volatility, forward-looking volatility of the term structure of the US yield curve. So basically, this is quite a mouthful, I know, but it's basically how quickly the term structure of the US yield curve will change. So what drives the term structure of the US yield curve? It's the front end, so the Fed, or it's a back end, which is more growth and inflation driven. If the MOVE index is high, that means there's a lot of uncertainty about the outlook of the term structure of the US yield curve, which means there's uncertainty around the Fed and there's uncertainty around the back end, so about inflation and growth. So with that, we shouldn't be surprised that the MOVE index right now is high, because the Fed is priced for a lot of cuts. They've just been through a super steep hiking cycle, and where to from here? It could be anywhere, right? So because of that, the front end will be priced to be volatile, and at the back end, we are coming off record levels of inflation, and the outcome once again is quite binary. Will inflation come down all the way to 2 or below, or will it be sticky? So again, a lot of uncertainty. And then the last element, growth, like global growth. A recession is basically fully priced. Will it be a soft landing, a hard landing? Just so much uncertainty about where the back end of the curve is going to go and where the front end is going to go. And with that, obviously, the MOVE index is very high. So the question is also about the implications. I don't want to focus on the implications, actually. For me, it's just the messaging of this MOVE index being high. It's just brace yourself. There will be a lot of uncertainty in terms of growth, inflation, and what the Fed is going to do. And we need to monitor it very closely.
So this next question actually follows on a bit about what you were saying with the Fed. So you said the Fed is done hiking, but you've said this before. How are you sure this time?
One can never be 100% sure, so we'll say that. We don't even think the Fed is entirely done. So as I said in the webinar,
there's actually quite a high probability of a last final 25 basis point move. But yes, I will say that we really do think that we are at the peak of the rate hiking cycle. Why are we sure that this is right this time? Well, I mean, reality is that we do think that inflation is coming down quickly. Yes, in certain areas, as shown earlier, it remains sticky, but over the long term, the US is going to be a 2% inflation economy. And with that, you cannot run at a level of like 5% nominal or 3% eventually real front-end rates. That will not be sustainable. So eventually rates will come down again, and I don't think that we will see much more hikes. So that's basically at the heart of it. And as said, there's just so much uncertainty. There's so much uncertainty around global growth and so much uncertainty around the banking situation, the banking crisis. So we think it's all resolved and it's fine, but still the Fed is going to be more and more cautious. And we can see that also from the Fed meetings. The Fed minutes all suggest that they are massively worried about downside risks to global growth now, which they hadn't said before. So yeah, if one reads between the lines and looks at what the Fed is actually saying, plus what the market most importantly is pricing for, it makes perfect sense to assume they're right at the top of the hiking cycle.
Thanks, Basti. So there's a fund-specific question here. When it comes to fund positioning, and I'm assuming this is on the balanced or defensive fund, are the funds cautiously positioned or do they have a more bullish stance?
Yeah, so I mean, I think for us structurally, we are more cautious in general. Why do I say that? Well, generally we run a little bit less equity than the overall peer group. That's not less equity than everybody. There are some very flexible funds out there that go all the way to 0% equities. We don't do that. We stick pretty much to an anchor, a foundation within our portfolios, and then we take a tilt. That foundation, though, is generally lower than a lot of the peer group. So I'd say structurally, we're actually more cautious than a lot of peers. And the evidence also does suggest that. So we run at a volatility profile, which is around 3% on average less than the peer group. That also comes from our hyper diversification within the funds. So we've got literally over 5,000 issuances within our funds, and that gives us a massive degree of diversification away from single stock risk. Tactically, I would say there's a bit of a mix. Let's call it a barbell type structure at the moment. I've showed you in the webinar that we are currently strong overweight on emerging market equities, and we're strong underweight on developed market equities. What that means is that we've got no more equity risk than normal, but we've just shifted that equity risk a little bit towards emerging markets, where we are seeing a bit more of an emerging growth case, and away from the still top-heavy US equity market, where the growth case is not negative yet, but certainly experiencing some serious headwinds. So I'd say on the tactical view, we are pretty much on a mixed bag, but generally we are more cautious than peer group.
Thanks, Rupert. This question is quite contentious. With Eskom load shedding escalating to stage 6 and possibly beyond in winter, how do you think asset classes will fare?
Yeah, well, I'm not sure how many of you had a cold shower this morning, but I think we're all experiencing stage 6 together. So yeah, good question around that. So stage 6 load shedding, we're not really going to predict the impact on asset classes. I think a lot of the impacts on asset classes in South Africa, we've talked about this before, are exogenous. So we see a lot of external money moving in and out of South Africa, investing and moving markets. That's on a macro level. I think more around the SA growth outlook, there surely has to be headwinds in SA growth from everyone having to run generators in their basement, increased base costs, lower operating profits. It's definitely a headwind in that regard for SA equities. And I think that just talks again towards our hyper diversification approach. We often get the question, why do we have so much offshore? Well, it's for exactly the reasons like this. SA may have been the darling child last year, but there is significant concentration risk within South Africa. And it can be the ugly duckling this year, just as easy as it was the darling child last year. So we much prefer to have less concentrated SA specific risk and use up the full 45% offshore limit at the moment.
Okay, cool. We've got 2 more questions that have come through now. So why would local investors take on all high risks and costs for fund managers when they can get 8.25 to 8.5% on cash in South Africa? Not everyone exceeds the tax-free interest limit.
I'll take that one, especially when it comes to taking on costs for fund manager. That plays into our cards. So as you know, our balance fund is just 30 basis points management fee below 50 bips TIC. So not too much costs to take on if you run as Prescient. Anyway, having said that, I without too much marketing around ourselves here, it's a good point. I mean, 8.25 to 8.5 on cash. So yeah, why take risk? And I have to say, fair point. So there are a lot of risks out there, and there's no need to take too much risk to get a high nominal rate. Yet I do want to put it into perspective a little bit. We had a 7% inflation print in South Africa recently. So the 8.25, 8.5% printed, which one can get on cash, that is actually just the CPI plus 1 or 2. So it looks better than what it is. Our income provider fund, for example, runs at a yield above 10% now with very little risk and still in line with CPI plus 3. So yes, the front end is becoming quite attractive. Yet there are also opportunities in the riskier space. So for example, if I look at the PE ratio for South African equities, with all the negativity around load shedding, which we've discussed, etc., we just had like 10 or 11 PE ratio, which implies almost 9 CPI plus 9. If I would just use the PE ratio as a predictor of future returns, which is obviously oversimplifying things, but that's an asset class priced for CPI plus 9. While the 8.5 stated is a CPI plus 1.5 right now. So yes, front-end rates are high, front-end rates are attractive, something we will utilize, especially in our income fund, especially in an asset allocation fund like our balance fund. We can move there, but the reality is there are riskier assets also priced to quite attractive levels.
Okay, this is the last question we'll take. How is the portable alpha or fixed income component currently positioned? Given much higher rates, have you taken on a bit more risk here?
Not quite. We're actually taking risk off. So we took risk on while interest rates were priced to move higher. So not necessarily when they move higher, but when they were priced to move higher. So we had an extremely steep term structure. So you got paid for taking on 1 year, 2 year, 3 year interest rate risk compared to floating. Where we are now is a situation that the front end of the curve is as high as the 2 year, 3 year space. So there's no more hikes priced. And with that, we get the same interest rates in the floating space as compared to the 2 year, 3 year space. So what we're doing within our portable alpha strategies and also within the balance fund or within defensive for the portable alpha component, we are taking more floating rate exposure plus a little bit of a credit pickup, obviously conservative in line with where regulation forces us to be anyway. So, but yeah, I guess the environment is attractive for these portable alpha strategies in the way that you're getting exactly these quite high front-end interest rates, and we're feeling it. We have a quite significant positive contribution from portable alpha to our balance fund this year, and we're also feeling it in all our core equity strategies, be it locally, be it globally. Quite positive alpha this year, last year. So they're doing well, and it's on the back of having gotten it right with this hiking cycle.
Great. Thanks so much, Basti and Rupert. And thank you, everybody, for joining us today. We hope you enjoyed it. Bye.
Thanks, Jess.